Wednesday with Brent Wilsey, president of Wilsey Asset Management.
Hey there, my name is Chase Wilsey, vice president actually at Wilsey Asset Management, and you've been hearing a lot in the news, maybe this term stagflation. Well, what is stagflation? This is what we saw back in the 1970s, 1980s, and it was a very difficult time in the economy. It's when we have high unemployment, we have high inflation, and also too, we really have low economic growth. None of those things are really something that we want to be seeing in an economy. To kind of compare where we're at today versus where we were back then, that is a very important starting point and hopefully helping to calm your fears. Back in the 70s, 80s, we did see inflation peak at around 15%. Unemployment, well, that actually spiked at nearly 10.8%. Where are we today? Well, most recently we saw CPI, or the inflation reading, at 2.4%. Unemployment still around 4.4%. And even with the situation in Iran right now, we are still looking at economic growth by analysts at around 2% this year. I do want to make the claim here that inflation will likely be increasing from that 2.4% level, but I just don't see it spiking in anywhere close to that 15% situation. Now, when we're looking at stagflation, what this concern is doing is it's putting a lot of pressure on bank stocks. Why is that? Well, it's for a multitude of reasons. Number one, consumers oftentimes, when they're faced with an economic crisis like that, they will stop paying on those consumer loans first. Many times those credit cards are victim number one. What that then does, it leads to delinquencies. People stop paying on it. That hurts the banks, those lenders there. Also, too, you have to understand how banks make money. They borrow money via things like CDs, checking accounts, savings accounts, and they'll pay those borrowers a rate of maybe, 2, 2.5%, 3%, depending on the situation. They then take that money and lend it out for things like mortgages, again, credit cards. Let's say they're lending it out around 4 or 5%. Well, the issue is if we have a stagflation, they locked in, let's say, mortgage rates around 3, 4, 5%, but now you have to pay more for those deposits and have to pay out, let's say, 5, 6, 7%. Well, now what is called NIM, or net interest margin, has really contracted or potentially gone negative. So that's the big concerns there that the financial companies are facing. Now, the thing I look at here, I think this is a buying opportunity. A lot of these stocks are down 10, maybe 15%. But I see this as temporary concerns. I don't think we're hitting that stagflation type environment. I do believe we should see oil prices start to subside here. They're not going to go back to where they were at the beginning of the year, but I don't think we'll close the year around $100 a barrel where we are today. So again, it's really just the fear in the market that is pushing these financial stocks lower, in my mind, creating a buying opportunity. You have to understand, too, many of these bank stocks, they do have diversified business lines as well. So they have investment banking, they have the consumer type loans, they have commercial loans. So they have much more diversified businesses than maybe they had back in 2008, 2009. And with all the regulatory scrutiny, they are in a much, much safer place. Again, I'll just look at two examples here. Wells Fargo, Bank of America, they are both down over 10%. They're both paying dividend yields around 2.5% and trading at a forward PE multiple around 10 times earnings. Historically, stocks around 16, 17 times. Again, I think this is a great, great buying opportunity for the right financial stocks here. Hopefully this helped ease your fears when it comes to the financial situation right now. For more information, you can go to smartinvesting2000.com. We have podcasts, newsletters, trying to make you a smarter investor.
This has been Wealth Wednesday, sponsored by Wilsey Asset Management.